Hey, this is Jeffrey with another edition of Stock Smart, the March 23rd, 2021 edition. Hope you're doing well. The VIX is up slightly. It's up to about 19.22. It's still in that safe zone. Remember, it's going to stay around 20 no matter what now. So anything under 20 is kind of a safe zone. Doesn't mean there's a lot of buying going on. It just means we're not in any kind of immediate kind of urgency of scare or fear. We're still overbought on the S&P 500 oscillator, but we're winding down a bit over the last couple days. Get to a safe buying zone if we have a couple more days of unwind. 10-year note, which we're watching very closely, it's down slightly, about 2 or 3 basis points to around 1.65. Again, when the bond goes down, it means there are more buyers. When it goes up, there are more sellers. It's that simple. It's the reverse, but that's how it works. So this is the 1-year anniversary of the massive trough period of the S&P 500 of last year when the market lost nearly 30% with the fear of COVID spreading everywhere. From February 10th to March 23rd, the market lost somewhere near 30%. We talked a bit about McDonald's yesterday, and I wanted to drill down a little bit into McDonald's. And, most people don't know, and I've traveled a lot by car. I've taken my kids on several road trips, long road trips where you're eating out. And I always thought to myself, it's interesting to see what the price of a hamburger is in different places. Well, there are indexes like this that follow McDonald's, and most people don't realize that they think of McDonald's everywhere is the same, but it's not. McDonald's in New York is different than McDonald's in Seattle. And so the prices are different as well, and people don't realize that a Big Mac in New York is different than a Big Mac in Tulsa, Oklahoma, or in San Francisco, California, and the prices are different. And so let's look at some of those prices. So, what goes into the factor and why are the prices different? Well, let's look at a few of the prices and why they're different. So in Seattle, Washington, that is the most expensive place to buy a Big Mac. It's $6.39 to buy a Big Mac in Olympia, Washington. In the Bay Area, we'll say Sacramento, it's $5.09. Now you go somewhere like, let's say Montgomery, Alabama. The Big Mac is only $3.79. Now what goes into the factors of the pricing, right? Number one, it's labor costs. And number two, it's real estate. So McDonald's will be cheaper generally in places where the real estate is less. And they use they use Deloitte and Touche to come up with the pricing for different places in McDonald's. So it's recommended to the franchisor by the McDonald's company what they should charge for pricing. So, and that's based on different things. And a big thing is minimum wage. If the minimum wage in your state or in your city is higher, then they're going to probably be more expensive to eat a McDonald's Big Mac. And the same is true with real estate in places like San Francisco and Seattle, where the real estate in New York, real estate's more expensive, that gets passed on to the consumer. So there you go. So McDonald's is not the same everywhere you go. So just keep an eye on it when you travel. Next thing, I want to look at median prices for new homes are up 5%. Again, median price, so the average price in the area, up 5%. And we're getting stalls in housing starts because of the cost. Well, again, you're going to see more inflation. So let's look at all the things that have increased. Well, you've had really low interest rates. So a developer would have to buy a piece of property, and now the land has gotten more expensive because interest rates are cheaper, pushing the prices up. But now you're getting caught in a period where interest rates are going up, inflation's going up, and so you're getting more expensive labor costs. And we know, we've talked about it every day for the last 2 months on the show, how raw materials are going up every single day. And then at the end, you get the last slap in the face, if you will. The buyer can't afford as much because interest rates have gone up. So if you have $1 million loan and your house went up and your interest went up 1%, that's another $1,000 generally, let's just say in general, that you're going to pay on your mortgage every month. So that makes new development of homes stalling a little bit because developers are like, oh, we're going to sit in these. They're more expensive. We're not going to get what we want out of these. And so that's going to create probably a downturn in prices, actually. You'll probably see prices of real estate flatten now over the next year because interest rates are going up. And generally, if it gets more expensive to buy, then the seller can't charge for the same. We've had a big run in real estate in this country, but that's because interest rates have been low. If we get a bump in interest rates, and again, the interest rates you pay on your bond are not directly tied to whatever the interest rate the Fed has, but what happens is they're competing. So when bonds are competing against each other, the 10-year note competes against sort of some of these CMOs, collateralized mortgage obligations, and they compete against each other. And so that money has to go up, or those prices or the yields have to go up accordingly. Let's take a look at a stock now.
Stock watch.
We are a holding company. This is the marketing language, again, which we do here. We are a holding company which engages in trading, clearing, exchange technology, regulatory, securities listings, information, and public and private company services. It operates through the following segments: market services, corporate services, information services, and market technology. Now, I don't know if you're going to know this, but it's NASDAQ, ticker symbol NDAQ. And most of us, you hear about NASDAQ, you think, oh, it's the exchange that lists all the big growth companies, Like if you look at the triple Qs, they're like, we're the ETF of the NASDAQ, the growth companies, right? And that's where they start, generally. A lot of those high-flying IPOs of the new growth companies start on NASDAQ. But they're an exchange, and they make money, and they are publicly listed. So essentially what they do is they help companies go public, and they charge fees for this. Last year, 2020, despite it being COVID, was a record year for IPOs. And we finished with 471 IPOs, and NASDAQ launched 316 of those. So that's a gigantic amount of business NASDAQ does. And so far in 2021, and you can thank the SPAC community, which is the Specialty Purpose Acquisition Group or company, and you can thank them for bumping IPOs even more this year. So what should follow is NASDAQ should do well. Because I've already looked and I'm kind of just piecing it together, and we're through like 2.5 months here. NASDAQ's already launched something over 200 IPOs, and a lot of those are SPACs. I think there's 70, 80 SPACs that they've launched, maybe more. So if they're the primary launching pad for the SPACs, we're hearing about a new SPAC or 3 new SPACs every day, well then it should follow that NASDAQ is doing very well. So take a look at the stock, NDAQ, NASDAQ. It's up a little bit today, about 1%. Stock's making a nice pattern, has made a nice move over the last year, a technical reading. Things up about 80% over the last year. And it should be, because it is doing increasing numbers of transactions and growing their business. And that's what moves companies. And most of us think about NASDAQ, they think about, these top companies like Amazon that launch on the NASDAQ, or any of these companies that are on the NASDAQ. But they don't think about NASDAQ as a stock itself. It's kind of funny. And what's actually interesting is NASDAQ trades according to the index NASDAQ. If you pull up the 2 stocks, which are NASDAQ, NDAQ, and the index, which is IXIC, the index of the NASDAQ, they trade perfectly correlated. And I don't know if it's like people can't get over the idea that NASDAQ, the company, is not the same as NASDAQ, the index. For some reason, it doesn't seem like it, because the corollary is so perfect, the way that they trade together. And if you pull up the 2 patterns and lay them on top of each other, they trade about the same. And over 6 months period of time, the companies in the NASDAQ, or I should say the NASDAQ, the stock is 24% up, and the companies in the NASDAQ are up 25%. So it's kind of interesting to watch, though NASDAQ has a different business than all those other companies that are in its index. So I got a question from Todd.
The average
Todd
investor.
says, I'm going to meet with a financial advisor. And this is a good question. By the way, I am a financial advisor. So Todd, you can come to me if you have a question, or if you did. Or, I do have 2 companies that I work with, and I have a partner, and we could help you with your finances as well if you're needed. And you can reach out, and thanks for all the questions, everyone. You can reach out to me at jeffrey@jeffreycamus.com. But Todd wants to know, what questions should I ask? And this is a great question, because people go in and they're like, I don't know anything about my finances. Well, you don't have to know everything about the market and what it does, but you should know what to ask your financial advisor. It's a great question. Number 1 question you should ask right off the bat: are you a fiduciary? And you know what a fiduciary is? It means that the person who manages your money puts you in front of their own interests. And I'll tell you, and I don't want to give a bad name to a broker-dealer or agents who work for broker-dealers, but an agent, that's somebody generally who is going to sell you a product like an annuity. They're not fiduciaries. They're there to sell products to you. But an investment advisor, or an investment advisor representative, is essentially what I should say, is somebody who works for an investment advisor, which is a firm. And the investment advisor representative essentially is a fiduciary. And as a fiduciary, they're there to protect your interests. So make sure you ask that question right off the bat. And no double talk. Don't take any double talk from it. Are you a fiduciary? And if they're an investment advisor representative, they are fiduciaries. Number two, what I'd ask is I'd say, how do you get paid? Right? Because there are a lot of different ways people can put cost structures on you. But I would say, make sure that it's fee only, not transaction based or any kind of funnel fee or, some type of other fee based on, percentage of growth, which a hedge fund would do. Hedge funds were famous in the day for charging 2 and 20%. That's going away, going by the board a little bit because, it's too much. 2% essentially of your total assets under management and then 20%. So how do you get paid? That's a great question to ask. And then what are your all-in costs? What else would I expect to owe you? What are my costs for, people don't realize that mutual funds and ETFs have another cost on top of the management fee they're going to pay to the advisor to represent them. And back in the day, there were these things called American funds. And I remember before I was in this industry, my mom was in all these American funds and they were great. They did really well. The only problem is my mom didn't know that some of those had heavy load charges and their annual cost could be 2 and 2.5%. Well, that erodes your interest that you're going to earn or your compound interest that you're going to earn over time. It's like 1% mutual fund fee could cost somebody who's starting to invest now over $500,000 or $600,000 over the life of it. And a lot of people at a lot of these firms, what they're going to do to you is they're going to put you in essentially a mutual fund and not manage your account. And you're going to pay for the mutual fund expense and you're going to pay the advisor's expense. So that's a double whack right there. So that's what you need to know. What's all in? And then I'd ask about investment philosophy. There's a lot of questions you can ask, but this is probably the last one we're going to talk about today. How do you invest? And I would say an advisor should say to you, they should say, well, we need to talk to each other. We need to get to know each other. What's your goals? What's your financial plan? What's your outlook? Do you have kids that need to pay for college for? When do you plan on retiring? What does that retirement look like? And that's how you build that relationship. They need to know what your future looks like, and then they can work with you and ask you questions. And then again, your portfolio should be tailored to your risk structure. One of the first things an advisor should come in and do is ask you a series of questions and then also put you through kind of a risk analysis so that you can get a portfolio that matches your risk level. How much risk can you take? And a good financial advisor, by the way, doesn't just ask those questions or have a question of a form. They really have to understand, having spoken to you, what your real risk tolerance is. And then your time horizon is important. Are you someone who's going to work for another 30 years and build wealth for a long time? Or are you at the end of your work period where you need to preserve your wealth? And that's somebody who may be in a portfolio that has 70, 60% bonds in wealth preservation or fixed income. And then the rest of it is maybe growth. So there's a lot of questions. I appreciate the question from you, Todd. And those are some questions you may want to ask your financial advisor. But hey, thanks for listening, everyone. The growth of the show is great. We'll see you again next time on Stock Smart.